like to take a quick dash around the world and touch briefly on some of the countries and regions of special interest in terms of their own deal flow. And now, again, we're still talking about deals into the U.S. And we'll focus first on maybe 3 of the 4 BRIC countries. We can sort of move Brazil to one side, and let's start with the C. Let's start with China.
I think Chinese investments into the US are likely to continue. I think the underlying driver with Chinese investments is, as with all emerging markets, it's partly just access to the best and the biggest market in the world. But for Chinese investments as well, they have the natural resources element and the wish to get access to natural resources. And at least the way I see it, and wishing to get access to know-how and technology, as Steve was mentioned before, I think that's a real driver with the way that the Chinese institutions are looking at investments into the US, and that will continue. So that underlying driver will be there. China is more cash-rich than most of the other countries that we're dealing with. They have a lot of spare capital that they need to invest, and China, it's not just sovereign wealth funds. The state-owned enterprises there are all a part of a coordinated government. So I see that continuing, and we're seeing it even over the last couple of months. We're still seeing Chinese interest in investments into the US.
And they've learned, and they're going to learn and continue to learn how to do deals in the US. So it's going to be friendly only. They've learned their lesson from Unical. It's not going to be unsolicited type transactions. It's going to be more diligence than they had done before. It's going to be with potentially partners. They're learning, and they will continue to learn how to do deals into the U.S., and I think they've learned from some of their past missteps.
Less political sensitive as well?
Let's try to be less political sensitive industries, more advanced work done with, with the government on CFIUS and everything else. So they're getting much better at learning how to do the right deals in the right way in the U.S.
Now, India is interesting because, again, over the past, I would say, a couple years, you've seen some real mega deals come out of Tata, one company, not only in the U.S. but in Europe as well. I think underlying those mega deals are or have been some very aggressive smaller companies that are, again, it appears, looking for markets and technology. Is this again, is it likely to continue?
I think so, yes. I think actually with the Indian companies, I think it's less been about technology, definitely about markets. I think with the Indian companies, there's been a theme of brands. I think whereas China, there's been a conscious policy to promote Chinese brands. I think in India there's a feeling that there's an arbitrage, if you like, to be had between the production in India and the Western brands and the money that can be made from that. So Tata Motors going into the UK and buying Jaguar, buying Land Rover, and that's all part of that sort of theme.
On the deals that we've seen inbound investment to the US from India, there was more technology driven over the past couple of years. This year, seeing, well, the deal flow coming from India, at least what I've seen in my own, again, not in the macro, but the micro, what's coming across my desk. What's coming from India sort of matches what we've been seeing from Capital IQ, which is it's dropped off quite a bit. But earlier in the year, I would say that's very true about trying to get the US brands, but also looking a lot of services businesses and what pieces can they break out and just bring back and make a business back in India, and how much of that can they sort of acquire to outsource themselves. So for example, they're picking up a lot of services businesses, doing a real hard analysis on, all right, of this business, what can we maintain that's US brand? What can we maintain that's high value US marketplace? Strip out as much back office as possible and send it back to our folks in India, where we've got just benches of people ready to go.
I think that was true as well in some manufacturing. They were looking at, say, a foundry in the U.S., saying, okay, we can bring back most of the production to India and leave whatever marketing and sales. All right, Russia. Of course, they're stuck on the wrong end of a rapidly declining, in terms of value, resource that seemed to, and I'm talking about oil, that seemed to be the driver for almost everything they did economically. Are they pretty much done, at least for the time being? Anybody?
A lot of the Russian deal activity was driven by the Russian oligarchs who made a ton of money in a short period of time. They were deal machines. They grew up on deals. They liked deals. They would do transactions as their normal course of business, and they would do them pretty quickly and pretty aggressively on price. Now they're much more challenged, and I think without the oligarchs driving the transactions, there's less of an impetus from the Russian firms. So I think you'll see less Russian cross-border deals as opposed to China or India. I think you'll see less of a drop-off. I think Russia will see more of a drop-off.
But the ones we were saying, though, were technology-driven a lot. There were a lot of, although there's oil, a lot of natural resources, what we were saying were a lot of tech transactions. And the comment that kept coming up a lot of times from clients was, clients that were being acquired or we were working with them post-acquisition, especially in the technology sector. We're supposed to start sending reports and information back over, and 15 years ago we weren't allowed to even like these guys and talk to them, and it's kind of a weird dynamic now. Now they own us. Now what? Well, you sort of got to give it to them and work with that. But they tended to be technology driven, but it's been a big drop off.